Have you ever wondered how safe your money really is in the hands of big banks? And what would happen to your financial future if the system you trust suddenly collapsed? These are questions we rarely think about until it's too late. In 2008, millions of people around the world faced that harsh reality as the global financial system crumbled. Behind the scenes, large financial institutions like Lehman Brothers were playing a dangerous game with our economy, a game that almost destroyed it entirely. Today, we're going to uncover the story of how those very banks fueled one of the greatest financial crises in history and how it left everyday people to pick up the pieces. Share this video to a friend, give me a like and subscribe for more open eyes videos like this. It was 2007, and life in the financial world felt almost too good to be true. From Wall Street's high-powered trading floors to the main streets where everyday Americans lived, wealth was seemingly everywhere. The housing market was booming. Families who had never imagined owning a home were handed keys to brand new properties. Credit was flowing freely like water, and it felt like prosperity was accessible to anyone who wanted. I remember vividly walking past towering skyscrapers in New York City, home to the biggest financial institutions in the world. Banks like Lehman Brothers, Bear Stearns, Goldman Sachs, and JP Morgan Chase. These institutions were the epitome of wealth and power. The suits behind the glass walls were making deals that seemed to defy gravity. Housing prices were rising endlessly, and the stock market was climbing. As I watched the world around me, I couldn't shake the feeling that something wasn't quite right. How could all of this wealth be real? How could everyday people with no substantial savings afford homes that cost hundreds of thousands, sometimes even millions of dollars? And how were the banks so eager to lend, even when the risks seemed clear? As I dug deeper, I would soon discover that this illusion of wealth was being built on a house of cards, and it was all about to come crashing down.
By early 2008, the cracks in the financial system were becoming impossible to ignore. At the center of the storm was the housing market, and it turned out that much of the so-called prosperity was fueled by something called subprime mortgages. In simple terms, subprime mortgages were loans given to people with poor credit histories, often at higher interest rates. These were people who, under normal circumstances, wouldn't have qualified for a traditional mortgage. The banks, however, had found a way to make these risky loans seem like a good idea. They bundled these subprime mortgages together with other loans into something called mortgage-backed securities, which were sold to investors all over the world. These securities seemed safe because they were based on the assumption that housing prices would keep going up. After all, if someone couldn't pay their mortgage, they could just sell their house for more than they owed. It was a win-win. Until it wasn't. As housing prices began to level off and eventually fall, the real danger of subprime mortgages came to light. Suddenly, people who had been given loans they couldn't really afford found themselves unable to make their payments. Foreclosures started piling up, and with each new foreclosure, the value of homes in the neighborhood dropped further. People were stuck in homes they couldn't sell, and banks were left holding the bag. What made this situation so much worse was the fact that these subprime loans weren't just owned by individual banks. Thanks to those mortgage-backed securities, investors, pension funds, and financial institutions all over the world were now exposed to these toxic assets. It was a ticking time bomb, and it was about to explode.
Of all the major players in the financial crisis, Lehman Brothers was one of the biggest, and its downfall marked the beginning of the end for the financial system as we knew it. Lehman Brothers, like many other banks, had heavily invested in mortgage-backed securities, making billions by betting on the housing market. They believed that as long as housing prices kept rising, they would never lose. But by mid-2008, the market for mortgage-backed securities had dried up. Banks, including Lehman, were holding onto assets that were rapidly losing value. The housing market was collapsing, and no one wanted to buy these toxic securities anymore. Lehman's stock plummeted, and investors began to lose faith in the bank's ability to survive. Behind closed doors, there was panic. Lehman Brothers was running out of money fast. They tried to sell the company, first to a Korean bank, then to Barclays in the UK, but each deal fell through. Finally, on September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in U.S. history, and it sent shockwaves through the entire global financial system. With Lehman's collapse, it became clear that the problem wasn't isolated. Other major banks like Bear Stearns, AIG, and Merrill Lynch were all facing similar issues. They had all been playing the same game, and now the consequences were undeniable. But while Lehman Brothers was allowed to fail, others wouldn't meet the same fate. As the financial system spiraled into chaos, the U.S. government faced an impossible decision. The banks were on the brink of collapse, and if they went under, the entire global economy could go with them. Millions of jobs would be lost, businesses would fail, and families would lose their homes. But there was another side to the story. Many argued that the banks had caused this crisis with their reckless behavior, and they should face the consequences. In the end, the U.S. government chose to step in with a massive bailout. The Troubled Asset Relief Program, TARP, was created to inject $700 billion into the financial system. The goal was to buy up those toxic mortgage-backed securities and provide capital to the banks so they could stay afloat. Major institutions like Citigroup, Bank of America, and AIG received billions in taxpayer money to prevent them from going under. For many, this bailout was a bitter pill to swallow. On one hand, it likely prevented a total economic collapse, but on the other, it felt like the government was rewarding the very institutions that had caused the crisis in the first place. Ordinary people were losing their homes and their jobs, while bankers received bonuses and continued to profit from the recovery. The outrage was palpable, and it raised serious questions about fairness in the financial system.
More than a decade after the 2008 financial crisis, the world is still feeling its effects. Millions of people lost their homes, their jobs, and their life savings. Entire communities were devastated, and the trust in the financial system was shattered. The economy eventually recovered, but the scars of the crisis remain. So, what have we learned? One thing is clear. The financial system is incredibly interconnected. What happens on Wall Street can quickly ripple through Main Street and across the globe. The risks that big banks take can have real, devastating consequences for everyday people. In the aftermath of the crisis, new regulations were put in place to try and prevent something like this from happening again. The Dodd-Frank Act was passed to increase oversight of the financial system and limit the risks that banks could take. But even with these reforms, some worry that the same problems that caused the 2008 crisis still exist today. The story of the 2008 financial crisis is a cautionary tale about greed, risk, and the dangers of unchecked power. It's a reminder that while banks and financial institutions may seem too big to fail, they are never too big to be held accountable. The question now is whether we've learned enough to prevent history from repeating itself, or whether we're still building the next financial crisis, one risky decision at a time. As I look back at that time, I can't help but wonder what would have happened if the banks had been allowed to fail. Would we be in a better position today? Or would the collapse have been even worse? One thing's for sure. The crisis exposed the fragility of the financial system, and we should never forget how quickly the illusion of wealth can disappear. Don't forget to subscribe and click on the first link in the description.